A factory floor full of heavy steel machinery is easy to value. You can touch it, weigh it, and measure its output. But today's modern economy runs on a different kind of machinery: intellectual property, brand recognition, and exclusive rights. These are intangible assets. By definition, they are identifiable, non-monetary assets that lack physical substance. We are talking about patents, trademarks, copyrights, and goodwill. Because these assets lack physical form, tracking them on a balance sheet presents a mechanical problem. You have to measure their initial cost and track how they are consumed over time without violating the strict principle of accounting conservatism. To prevent corporations from inventing phantom value on their balance sheets, GAAP relies on a rigid logical framework to map out exactly what counts as an asset and what must be immediately expensed. We can organize this framework into a master decision matrix based on 3 distinct phases of an asset's lifecycle: origin, lifespan, and defense. Every complex exam question regarding intangibles can be solved by running the specific asset through this logical circuit. By applying these 3 nodes, complex scenarios resolve themselves through a systematic sequence rather than a reliance on memorized lists. The first filter is origin. Externally acquired assets are capitalized. Internally developed R&D is expensed, except direct costs like legal fees. The third path, business combinations, generates goodwill. Goodwill equals total consideration plus non-controlling and previously held equity minus fair value of net assets acquired. Under no circumstances can internally generated goodwill be recognized on financial statements. It must result from an external acquisition. The origin node acts as the ultimate gatekeeper. It determines whether a cash outlay transforms into a recognized asset to support future value, or vanishes off the balance sheet as a current period expense. For capitalized assets, the next test is lifespan. Finite life assets are amortized over the shorter of their estimated economic or remaining legal life. Conversely, indefinite life assets, like goodwill, are never amortized. They are periodically tested for impairment. We can test this logic against a standard examination scenario. This question asks which acquired assets are potentially amortizable. Based on our matrix, goodwill has an indefinite life and is never amortized. Trademarks, however, can have a finite life, meaning they can be amortized. Therefore, the only viable answer is B. The lifespan node functions as a financial timer, dictating exactly how fast the recognized value of an asset bleeds away on the balance sheet. The final event-driven node dictates what happens during a patent lawsuit. A successful defense preserves future economic benefit, so legal costs are capitalized and amortized. An unsuccessful defense loses that benefit. Legal costs are immediately expensed, triggering an impairment test on the core patent. We can verify the binary outcome of this rule with another test case. This question asks when legal fees incurred in defending patent rights should be capitalized. The matrix dictates a direct mapping: yes for a successful defense and no for an unsuccessful one, leading straight to answer B. We can apply the exact same logic to a quantitative scenario, bifurcating mixed legal costs based on the verdict. A company incurs $500,000 in legal costs. $400,000 are for successful outcomes, $100,000 for unsuccessful. The prompt asks for the amount to expense. We only expense unsuccessful outcomes, making C the correct answer. In corporate accounting, courtroom verdicts dictate the financial reality of the balance sheet. They are the sole determinant of whether millions of dollars in legal fees become structural assets or immediately recognized losses. When we pull back and look at the complete system, we see a continuous circuit of financial logic. As we've seen, origin determines its initial existence, its specific lifespan determines its degradation, and litigation determines its survival. These rules enforce the principle of accounting conservatism. They ensure that a company can only claim invisible value when it is mathematically measurable and legally undeniable. This matrix serves as a professional standard for identifying the true financial substance hidden behind the abstract numbers of a corporate balance sheet.